Hey guys, this is Mr. Breen, and in this video I'm going to be talking about stocks. Stocks are basically ownership in a company. So if you buy a bond, you don't actually own part of the company. You can't make any decisions for the company, but if you own stocks, you do have some ownership in the company. There are a couple kinds of stocks. There are the common stocks, and common stocks actually give you a vote at shareholder meetings. So if you own one share of common stock, you can vote at shareholder meetings, whereas preferred stock gets no vote. It's a trade-off. You don't get a vote. But what you do get is you get your dividends earlier than those who have common stock. Because stocks are ownership, they are sometimes also called equities, because you have some equity or ownership in the company. So how do you make money from a stock? Well, with bonds, you make money by collecting coupon payments, collecting an interest rate. Or you can sell them for a different price than you bought them for under certain circumstances. But with a stock, well, there are two kinds of stocks in terms of making money from them. There are income stocks, which are stocks that pay a dividend. So the corporation, if they make a profit in a given year, they might pay some of those profits to their stockholders, per share of stock. So maybe per share of stock, you get 50 cents in dividends over the course of a year. So if you own 1,000, then if you own 1,000 shares, then you can get $500 in dividends over the course of a year. So that's an income stock. With a growth stock, instead, you don't get a dividend. The corporation reinvests all their profits into the company. And then because they're reinvesting those profits, the company grows, the company gains more assets, and therefore owning a piece of the company is now more valuable. So you hope that the price of the stock goes up over time, and that's called capital gain. Of course, the point of capital gain is that you sell those stocks later for more than you bought them for and make a profit on the difference. So where can you buy stocks? Well, you can buy them at a stock exchange like the New York Stock Exchange, but those tend to be fairly pricey to get into. You can't just walk into those. So you could also buy them from a stockbroker at a brokerage firm. So these are people that you can call up and you pay them a commission. But once you pay them, then you can say, well, buy me 100 shares of Apple, and they'll buy you 100 shares of Apple. Or you could buy them over the counter or in the OTC market. So OTC, over the counter, this might be online. So there are certain places where you could buy stocks online. Primarily, the really big online stock exchange is the NASDAQ, the NASDAQ, and that's over the counter. So for bonds, we had various companies that tell us how risky different corporations and governments are in terms of their ability to pay their bonds back. With stocks, we can track the performance of the stock market in general through stock indices or a stock index. So what you might do is you might choose some stocks and you'll add the price of those stocks together. And if those prices go up on average, then your stock index will also go up. And if they go down on average, then the stock index will go down. So two of the most important stock indices are the Standard & Poor's 500, the S&P 500. This is actually a company that also does bond ratings, or the Dow Jones Industrial Average, also known as the Dow. Just another important terminology note, you might hear the words bull market or bear market. All this means is that a bull market is a market that in which the stock prices are going up. So this is a good thing for investors. And a bear market is when stock prices are going down. So that's bad for investors. You might hear this used in other ways. So if somebody is optimistic, they are called bullish or they're a bull. If they're pessimistic, then they're bearish or they're a bear. Why do we call the rising stock market a bull market and a dropping stock market a bear market? I don't know exactly, but they always say that a bull attacks upward. If you can imagine a bull attacking you and trying to gore you, that it sort of makes an upward motion, whereas if a bear attacks you, it's like standing up and it falls on you, so it's attacking down. I don't know, but these are the terms that we use.